We are super happy to welcome you today for this webinar. I am Dunia, a part of the marketing team of ConsenSys. We are pleased to see you joining this webinar in partnership with Plaid and Gemini, discussing the convergence between open finance and DeFi. So the agenda for today will be to have a small introduction, 10-minute introduction from Lex Sacconi, global co-head of FinTech at ConsenSys and head economist at ConsenSys. And right after, we'll have a super insightful conversation with Dave, Keith, and Yuan for like discussing, of course, so how open finance solutions can help new audiences interact with DeFi protocols. And of course, we will wrap up the webinar with some Q&A. So feel free to add any question on the Q&A section or anything on the chat as well. And we will also record, of course, this webinar and share the link with you after the event. So without waiting maybe too much, I will give the floor to you, Lex.
Wonderful. Thank you so much. I see that we have photos for all of our panel participants that are very clearly pre-COVID because they feature haircuts and people are not wearing t-shirts. It's like a doppelganger from an alternate universe that if I ever touch, the time continuum will be broken. So it's nice to see what used to be. I'm really excited for this conversation in this panel, and we'll set a little bit of context up front with a story. But the exciting thing is that finance is being digitized and made modern in all sorts of ways. It's being nipped across all sorts of different vectors, and so that might generate buzzwords and lots of things that VCs like to invest in: embedded finance, open banking, decentralized finance, NFTs, crypto assets, digital assets, security tokens, and so on. But really, these are all symptoms of the same thing, which is that the financial and economic systems that we use are being melted down into software and reconstituted for something that is appropriate to our time. And so I would advise folks to really pay attention to the intersection of these themes of the digitization of traditional finance and the opening of traditional finance into APIs usable by large distribution footprints. And so we have lots of good folks to talk about that here. And then similarly, the change in the underlying financial product and what financial product even means, like what's the purpose, how is it put together, and so on. And that'll come from the blockchain and decentralized side. And then of course, firms that connect all that and intermediate it and exchange it. And so that's the framing. I'm gonna open up a little bit of that story using host disabled participant screen sharing. Dunia, are you able to project for me if I give you a link?
Of course, yes, of course, sure.
Okay, we will improvise in real time. So I'm sending you the link right now. And what the story is really about is how all this came together, allow them to edit. There we go. Everything's perfect. Nothing's fine. Nobody's freaking out. We don't need slides to talk. We have knowledge. Knowledge is not reliant on PowerPoints. So the kind of the core message, and whenever you have access to the screen, yeah, just please project it. Thank you. The core message is, how's finance made? Is it special? Is it different? Is it complicated, and so on? And often there are lots of fancy words to obscure what is actually happening in the industry. And the answer is the industry is just as straightforward as really anything else. A car manufacturing value chain, the folks that make sandwiches and delivered to stores at Pret or Subway. It is just an industry. And so we can start in a factory. We can start in the place where you make the stuff. So for your convenience, I have put a picture of a factory into a slide so that we're anchored in what that means. And you can see the assembly line and you can start to think, okay, well, what's a financial factory? And the answer is there is somewhere where payments are made. There's some sort of payment rail on which capital moves. There's somewhere where capital sits. There's some account, there's some address, and you can think of the depository activities of banks or the underwriting activities of lenders as powering this up. There's somewhere that an investment product is put together. Somebody selects investments and packages them into an asset allocation. And so not the broker, but the asset management firm. And similarly for insurance, somewhere there's the assessment of risk, the collection of premiums, and the creation of the transformation function of paying out in the event of catastrophe or default to the folks that pay the premium, the overall assets. And so again, these products are made, right? And if we go to the next slide, it conveniently has pictures of things that are financial products, and they might not look like sandwiches and they might not look like cars, but we know them, we see them, we touch them. So whether it's a payment product, a credit card, or a physical cash instrument, and then if we start looking into financial instruments and derivatives and things of that nature, and the certification of those and the legal wrapper around those, or we can think of them as this sort of transformation function of capital from one thing to another. And that's the little stock chart, that's really the investment product, is that stream of return that you're selling to people. So we're familiar with what a product is. It's tangible, we can touch it, we understand it, and it comes out from these factories. Next page, please. And these factories have to go somewhere. They, sandwiches go to stores, and coffee goes to Starbucks, and similarly, financial products go to a place where they live and they're sold. And so they might be sold at a bank branch or through a financial advisor or a lending officer. And that's the traditional world. And certainly the last year has melted that down pretty substantially. And over the last 20 years, things like websites and proximity payment processors and phone apps and things of that nature replaced or have been replacing the store for financial products. And you can see lots of kind of wiggly lines between the different types of stores and the different types of value chains and how they connect. And of course, increasingly, more and more, it is the digital native distribution. It's the stuff that we're staring at all day long, where our attention lives. That is the place where these products go to exist. And it's messy to have lots of different value chains that are functionally different. That the payment rails looks nothing like portfolio management software, looks nothing like banking underwriting software, regulated by different entities and so on. Next page, please. And so as we become more digital in our storefronts, what's happened is that there's emerged a new layer in the industry that connects and repackages and structures the stuff underneath it, those factories, into something that's a lot more modern. And so when we talk about open banking, not open finance, but when we talk about open banking, we're really talking about having the traditional industry open up what it does into software rails that interoperate with Web 2.0. And thereafter plug into these digital storefronts that we're all familiar with, whether they're the mobile payments apps of Square Cash, or they're the neobanks of Revolut or Robinhood, digital investing, or SoFi or Betterment or Money Farm, and so on. And then the interesting thing that's happening is that open banking and embedded finance has actually extended further to start re-digitizing incumbents and their storefronts, the bank branches, the financial advisors. And then it's also started to digitize and put finance into places where there didn't used to be finance. And so things like food delivery apps are now banks for the drivers that deliver the food. You know, the places where you might go to shop for small business, the small businesses where you might go shop are now also delivering financial services and payment rails to those small businesses like Shopify and Stripe. And so it's become a really powerful digital layer on top of the traditional manufacturers. Next page, please. Now, this story has even more boxes in it. Underneath the factories is lots of chunky software. So it's, you know, the companies are run on the left side on lots of disconnected portfolio management software and core banking software. That's very grindy and different, like geographically, and very complicated story there. Simultaneously, what's emerged over the last 12, 13 years is the blockchain networks. And the blockchain networks are both a legal and an economic property rights system that is truly a perfect fit for any financial primitive and any financial software that you can think of. And it is a core settlement and trust generation layer for really any economic activity. It's different from the Internet of Media in this way. It is different in that it is purpose-built for value transfer, securing that value transfer, and building market mechanisms on it. And out of that, new financial factories have emerged that are able to make these products. We call them decentralized finance protocols because it sounds cool. And also because they are in nature decentralized, because since they accrue to these global blockchain networks with 130 million Ethereum addresses and millions of people from every geography using them. Next, let's introduce the octopus. Perfect. Okay. So these now become complicated infrastructures. As the blockchain assets became valuable, you've had an amazing growth in players that support exchange of these crypto native assets, crypto native tokens and coins and so on. And so crypto exchanges, both on the retail side as well as the institutional side, have become really fantastic businesses that also, you know, largely focus on the distribution of these assets, and have had to reconnect to the traditional financial services rails. This is really hard. It's very expensive. And it's been an enormous lift for crypto exchanges to do this, as well as to connect to all of the underlying blockchains, and in certain cases to underlying blockchain protocols. Next page. To complicate the story further, we now also have crypto native applications that are another way for folks to access decentralized finance. So you might have a crypto wallet like MetaMask that you directly use for DeFi protocols sitting on Ethereum, and then you might have, you know, a Coinbase or a Gemini account, and then you might also have a Robinhood app, and you might have Venmo and Chime, right? And so there's a lot of complexity here in terms of the industry structure. But what we're seeing happen is a convergence of this more and more together. And so kind of to bring it back, we can go to the next page. So to bring it back to the core topic of open banking and decentralized finance and the thinking about the overlaps, you know, we know that there is a broad API layer that can now integrate traditional financial product into the crypto ecosystem. And so there are lots of good crypto native distribution companies that have clients that are trying to access digital assets. And these types of companies have to plug in to traditional money movement, to banking, to investments in a digitally native way, do data aggregation, and so on. And so that's the overlap between our kind of crypto native entities and exchanges and having them draw power from traditional finance. And then in the other direction, there's also the question of how do you help the traditional distributors, and now this includes the fintech footprints, access digital assets and crypto native finance? How do you leverage the alpha and the growth and the excitement about digital assets, inside of platforms, inside of digitized banks, inside of robo-advisors and digital investors? And so that's something that we at MetaMask Institutional, which is a ConsenSys company, think a ton about, and hopefully we'll cover on this panel. So thank you everybody for bearing with me for a story about sandwiches and factories, and hopefully this sets some context about the key terms that we're talking about. And with that, I'm delighted to pass it over to the panel.
Thank you, Lex. Thank you so much for bringing to life this great narrative. I think now Mattison and of course our amazing panelists will have a great challenge to find who is the octopus and who is the sandwich bakery, right? And what they are doing and how they can work together. So yeah, thank you so much, Lex, for this introduction. And Mattison, the floor is yours now.
Awesome. I'm going to hop right into the questions. I think it might be helpful if we just kind of briefly go over the panelists and what they touch upon. So Keith, would you mind just briefly giving a quick introduction of yourself?
Yeah, absolutely. Great to see everyone. I'm Keith Gross. I lead the UK and Europe for Plaid. And as Lex described so nicely for us, we are that digital API layer between traditional financial institutions and the fintechs and future fintechs of the world. And I run our UK and European business here based out of London. Thanks for having me.
Thank you, Keith. And Johan, would you mind telling us a little bit about MetaMask Institutional?
Good afternoon, everyone. Hi, Madison. My name is Johan Bornman. I am the product lead for MetaMask Institutional. My background is institutional finance, helped to build an investment business in London, and then moved into fintech too. And then now I've stepped into lead MetaMask Institutional, which I'm sure we'll dig into more in this panel.
Absolutely. And Dave, I've been a client of Gemini for years. Have appreciated Gemini's very trusted approach, very much regulatory appropriate approach to becoming a leading exchange. Would love to hear a little bit about what you do at Gemini.
That's great to hear, Madison. We always like happy customers. Dave Abner, I'm the head of global biz dev for Gemini. I'm trying to sort of square the circle on the square octopus, but that's firmly where, on Lex's slides, that's firmly where Gemini sits. We are, if you think all of the traditional financial firms as independents, Gemini is sort of one crypto native firm that provides services that look like a whole handful of traditional firms all wrapped up into one neat package. And I'm sure we'll talk about the details of that as we go.
Terrific. So I'm going to hop right into the questions now. So by any metric, DeFi has really experienced an explosion in growth. And what do I mean by growth? In the amount of users utilizing these DeFi applications, whether it's decentralized lending protocols, decentralized exchanges, even decentralized derivatives at this point, and also the amount of value that's being passed through these ecosystems. Total value locked is now quickly approaching $55 billion. This time last year, it was about 1 to 2 billion. The leading decentralized exchanges are doing about $1 billion in volume. It was a tenth of that, even less than a tenth of that. It was actually 600 million across the board for all decentralized exchanges back in January of 2020. And you've seen a dramatic growth in the total loans on these decentralized lending platforms as well. Outstanding loans are now have surpassed $10 billion from far less than $1 billion early last year. So what is DeFi in your own words, and why do you think there's been such unprecedented growth within this sector of the digital asset ecosystem?
I can chip in there to start. So I think if you think back about what happened in 2020, I mean, 2020 fundamentally changed the way people and businesses manage their finances. You had whole generations and entire new businesses who were moved into managing their lives from financial tools and digital tools for the first time. And I think that growth in the fintech ecosystem extended all the way into DeFi as well, right? Where you had people all of a sudden getting familiar with tools on their mobile devices, on their laptops that they'd never used before, and recognizing that actually this experience and getting this trust in the DeFi ecosystem isn't that different from some of the traditional financial tools I was seeing as well. So I think you had this whole influx of people changing the way they manage their lives and the way they manage their finances, and the growth in DeFi is part of that.
Absolutely. And then how do you see institutional actors benefiting from this incredibly large amount of growth that the DeFi ecosystem has experienced? It's really been very much retail driven up to this point. Where do you see that kind of switch getting turned on where institutional actors are now really benefiting, and how do you kind of view that developing?
Yeah, I'll jump into this one. It's very interesting. If you look at the adoption cycle within DeFi generally, it's exactly what you've painted. We've obviously seen DeFi degens step into the ecosystem first, and having experienced kind of hyper growth and hyper returns, as you pointed out, you are now seeing, you know, very kind of small cap and medium cap funds step into that space and chase these returns. And it's not surprising, given that these players essentially have less regulation in the way they're allowed to allocate capital. And I think what you'll see going forward is the adoption cycle very much follow how regulation is laid out and the regulatory freedom that these institutions have. Most likely what we're seeing now is larger funds stepping into the space to access DeFi, thinking about things like counterparty risk. And I think we're in a very important inflection point within DeFi generally. And we're seeing more tools coming to the market to help solve a lot of these risks, things like counterparties, things like best execution. And I think that will open up the door for wider adoption within traditional finance, and also larger players within the enterprise space move into DeFi. So I think today it's mostly on the capital allocation process. It's mostly funds chasing returns. But I think we're at a very big inflection point in the foreseeable future to cross that chasm to give institutions more access.
Yeah, I agree with Johan completely. I think it's still very early days. Like, we think about 55 billion as a huge number from a year ago where it was 2 billion, but these are small numbers still when you think about the institutional landscape and the trillions and trillions of dollars that they're managing, right? And they're managing generally, if you look at the investment product landscape, it's probably something like $20 trillion or more, and that's excluding fixed income. And they're managing it in a highly regulated framework. And there's so many risks to move to the DeFi protocols, and it's a clear evolutionary process. But I think what we're gonna see is baby steps from smaller institutions first that have more leeway around their operational procedures and more sort of control around their compliance and risk functionality. And you're seeing the same thing in the non-DeFi space, where you're seeing sort of, the push around, utilizing Bitcoin as a treasury function, right? The first stage movers are really sort of maverick CEOs that don't have to answer to an S&P 500 board. And, they can really control the sort of direction of the company. I think you're going to see the same thing in the DeFi space, right? It's even less regulated, although there's a clearer regulatory sort of evolutionary path ahead for it. But that's going to take some time for the sort of larger waves of institutions to flow in.
I would echo that treasury function as being, I think, the stepping bridge in between traditional players moving into crypto generally, and then DeFi coming after that. I think as you started to see with MicroStrategy and Square and some other pretty serious companies considering Bitcoin as part of their treasury management for the company more broadly, I think that is an interesting segue into more and more this might become an accepted part of traditional financial infrastructure. But I agree that's going to take a lot of time before you see traditional players really embracing DeFi, because they have to make that traditional step first.
You know,
Oh,
go ahead. Sorry, Dave.
sorry, Madison. I was just going to say to Keith, it's so interesting to see the people that want to do that, right? So Square, MicroStrategy, they've generated a tremendous amount of interest in the space. But the amount of people that we are interacting with that are sort of on the compliance and the risk side of the firms, where they've got CEOs that are saying, hey, we want to do this, right? We need to get some Bitcoin on our balance sheet. And we spend a tremendous amount of our time educating the teams to enable this, right? And thinking through the process of how do we get the board to agree? Like, we know this is a good idea, makes sense, but board approval is an entirely different education process. It's and that's, you know, that's a big sort of part of the process, which is why this stuff moves slower than you would think it should.
Absolutely. And you know, I really want to build off what Keith and Dave just mentioned. You know, bridging for Keith, much more the traditional kind of fintech world with crypto, and for Dave, the kind of centralized digital asset ecosystem into the more decentralized aspects such as DeFi. That is an incredibly you know, tall mountain to climb, but you know, it looks like will be incredibly beneficial for the end users. So you know, Keith, I'd be very interested, how is Plaid, excuse me, close to the decentralized paradigm? And how are you thinking about building bridges between effectively open finance and DeFi? And then Dave, I'm also very interested. I have a friend of mine, John, who's one of the co-founders of Shapeshift, fundamentally believes that centralized exchanges, you can see within their strategy, will end up in the coming years becoming the front end of DeFi, since at the end of the day, DeFi is largely a back-end technology. I'm wondering how Gemini is thinking about that as well.
Cool. I'll take your first question then, Madison. So I think for people that aren't familiar with Plaid, I guess I'll give a couple of definitions first. One is we function in the open banking and the open finance space. If you think about what that means, open banking is you as a user should be able to access your bank account via API and move money in any application or service. Open finance just takes that concept and extends it into other things outside of your bank account, your pension data, your savings, ultimately your crypto assets, I think, in the long run. And for us, philosophically, our mission is two things. One is unlocking financial freedom for everyone outside of that, right? You should have visibility and control over your own financial life, and making sure that you're able to do that with your own permission, move that money wherever you want. And that philosophically has a lot of ties to, I think, the underpinnings of both the DeFi movement and the crypto movement more broadly. And then in terms of how we're functioning in this ecosystem, our APIs can serve as the bridge from both a sort of validating the user on an onboarding perspective of you are who you say you are, which is really important from a regulatory side, but also actually helping transfer fiat funds via instant payment rails into centralized exchanges. So a lot of what Plaid helps do is create the really smooth on-ramp for people when they're first experiencing the crypto ecosystem and DeFi ecosystem. You know, if you're loading funds onto a Dharma, you're actually using Plaid's APIs and going through that process. And that's a lot of how we help smooth the ecosystem.
So Madison, seems like I'll jump in and talk about our plans for DeFi, or at least what I think the evolution is. And I've seen a lot of evolution, right? So I'm not really a student of history, but I've been in the financial markets for 25 years now. And, you know, I've seen things like the never-ending march of fees for end investors going lower, right? Like, so 25 years in financial markets, I have never in my lifetime seen fees for financial investors go higher. They always go lower, right? That's what evolution in history does. And but what I do see, but beyond that though, there's also always this concern for investors about understanding that the other side will be there when you've traded, right? Like in the traditional markets, we have things like centralized clearing houses in in, on the crypto exchanges, we don't have that. And we have independent pools of resources, basically, right? Gemini is its own ecosystem. When you come to trade on it, you're trading against other people that come to Gemini. But now you're seeing the development of aggregators where KYC AML is being done at a centralized spot, and then you can trade across multiple venues. And I actually think in terms of the decentralized exchanges, they're still going to require, or investors will still require, some form of KYC, AML. Is the firm I'm dealing with, Gemini is a regulated financial institution, and are there sort of books and records? We are SOC 2 Type 2 compliant, which means our books and records have been completely audited by a traditional accounting firm. As much as we want to develop peer-to-peer systems, because they're going to drive costs lower for investors, right? Faster, quicker rails, lower costs for investors. That's the way it's all going. There's still going to need to be this layer of screening for investors. So I think Gemini is super focused on this space, but we are going to be, like you mentioned, a sort of front door or the gateway platform for investors. What you always see is investor education is incredible, right? The DeFi platforms are amazing, but the documentation that's available for the level of investors that they want to attract and the due diligence that institutions would require is simply not available yet, right? That's going to be a layer that Gemini builds probably for that space. And then this concept around, is there some way in a DeFi landscape to at least know that there's been some clearance around KYC AML that we can monitor, that we can protect investors for? That's how we're going to become that layer of introduction for these. And then they're just going to plug in, I think, like the rest of the aggregation, right? Eventually you're going to, and you've seen it in traditional markets. You used to trade on the NYSE, you used to trade on Amex, then it went to investors, they're all trading in dark pools. Nobody knows where they trade anymore. I think you're going to see those same evolutions in these markets as well. And it's not going to be a function of where you trade, but are you getting speed and pricing that the way you should expect it to be? Sorry, long answer for a short question, maybe.
No, that's a really good answer, though, and it comprehensively hits on the points. And I actually appreciate, you directly kind of answering how Gemini is thinking about the DeFi space rather than, we're figuring out as the space evolves. So I really appreciate that detailed answer. Johan, I haven't forgotten you. Can you really share some examples and go through what you're building for custodians, considering, MetaMask Institutional is a relatively new product that really is focusing on the institutional market, which has a much kind of wider variety of demands, as kind of Dave just alluded to, than the traditional retail market that deals with MetaMask. And how does MetaMask Institutional really differ from the other options within the market?
Yeah, thanks, Madison. I think it's always helpful to start from first principles in a question like that. And I think if we look back to this end of last year, when we had an initial hypothesis around this idea that allocating capital in DeFi as an institutional investor is seriously painful today. It requires multiple hops, multiple transactions. You're potentially moving assets from cold storage to a hot wallet. You're connecting potentially a MetaMask wallet. You're scanning QR codes. One fund manager that I interviewed said to me they called it the summoning ceremony within their firm. And they had to make sure everyone was at the right place, right time. And so that really inefficient process was kind of really our first principle assumption hypothesis. And so we set out to build a solution that fundamentally solves that, and not just streamlines that process, but actually allows investors to have operational efficiency as well as infrastructure. So what does it actually mean? We essentially have built an API and an SDK that custodians can plug into MetaMask. And what that means is that first and foremost, we give institutional investors access to, with the most trusted DeFi wallets in the ecosystem, access to the entire DeFi world essentially within their browser. So we're aggregating that DeFi world within their browser. And then very importantly, by connecting to a custodian, we're allowing them to have essentially risk management process in place. So they can build, pre-trade compliance rules, they can build whitelisting rules and have risk management on par with what they have today within traditional finance as well as CeFi. And that obviously not just streamlines the process of capital allocation, but essentially allows them to have far better investment processes. So this is what we built today. We launched our beta on the 31st of January. Our version 1 went live on the 31st of March, so last week. And we spent a lot of time with funds over the last 2 months to fundamentally understand how do they allocate capital today, how do they surface investment ideas, the risk management they do, best execution, reporting, monitoring. And we're now standing up solutions and features in every single one of those categories. And some of the stuff we're partnering with other institutions, but within those categories, we're absolutely uniquely positioned as MetaMask and as well as ConsenSys to solve some of those user needs. And I think that segues beautifully into Dave's point around AML and KYC. We know this is a huge problem within Europe and Asia. We have the 5th AML directive. Larger funds in North America don't have the 5th AML directive, but they absolutely have to comply to the same sort of thinking around regulation. Like, how do I know who my counterparties are? And so we've actually have something we've built internally to help solve that need. And so again, thinking through user needs throughout the entire capital allocation process, and just making that capital allocation far more seamless.
Yeah, absolutely. And I speak with funds who are active in DeFi all the time. And one of their biggest pain point is that, the MetaMask product is today, how wonderful it is not set up for that sort of active institutional management within the DeFi space when it comes to those things, as you mentioned, compliance, when it comes to effectively tracking trades, the accounting aspect, etc. So, I'm a little biased, don't get me wrong, but I think there is a distinct need and definitely a demand for this product in the market. I'm really interested, going back to Dave, you see it, you hear all this news. I think it's news like Dan Loeb is now trading via a centralized exchange, a centralized crypto exchange. I believe that Stan Druckenmiller and some of the big other hedge fund managers have actually opted to go the route of trading on large centralized exchanges. From your experience, from your perspective, has that changed for Gemini in the past year, where it's really, you've seen a dramatic shift with these institutional players really coming to trade on Gemini?
Yeah, so look, a year ago, the business, Gemini's an interesting firm, right? The Winklevoss brothers were investing in Bitcoin very early on, as people know, and then they really built Gemini to be an institutional custodian and execution platform, partially to store their own assets, but also to integrate with their traditional financial assets that were already sitting in what we would, you might call the traditional financial world. So Gemini from the start was built to service institutions. And because of that, we are probably the most highly regulated CeFi exchange in existence today, right? And I'm not going to bore everybody with the regulatory details of what we do, but it's extensive. They were early, right? Like a year ago, large institutions were watching this space. Again, sort of there's always first adopters, but the real sort of pack and core of large institutions were not here yet. And so it was retail driven. And now, even in the 6 months that I've been at Gemini, we've seen a dramatic shift in actually what's interesting is institutional investors, right? So we're speaking to all of them very much like our counterparts. And it's an early education process still for many of them, right? Yeah, there are, like if we look at corporate treasuries, I think the total number of corporate treasuries holding Bitcoin today is something like 32, right? That number compared to the number of, corporate treasuries out there, it's minor, it's nothing, right? There's some big names, they get great news, but we are barely scratching the surface today. Dan Loeb is a great example of, well-known, great big investor utilizing the centralized exchanges because that's going to be his first stop. I think of Bitcoin as a gateway drug to crypto, and I think of centralized exchanges as sort of that gateway to the rest of the space, right? Like if I look at the space now, 80 to 90% of volume and assets is sitting in Bitcoin and Ethereum still, right? Like we need to, but I've seen this before in financial assets. So I came out of the ETF world, and for years, right, almost all the way from 2000 to 2010, 80 to 90% of ETF assets sat in spiders and queues, the S&P 500 and the NASDAQ 100 names, right? It wasn't until 2008, the financial crisis, when advisors started looking for new ways to expand and diversify their portfolios, that they started moving into the broader range of financial products. I think we're on the cusp of that here in the crypto space, right? So assets are concentrated right now. People are getting comfortable. And like I mentioned before, compliance and risk departments, those are the keys, right? We like to think that front-end business drives adoption, but nothing happens until those two departments can approve use of products. So as they get up to speed on the space, DeFi versus CeFi, and they start to understand what can be done, when they get comfortable, then people will start expanding across. That's the evolution process that I think we're going to happen. Unfortunately, it moves a little bit slower. Like money moves slowly in the regulated space because it takes time for regulators to catch up and understand what they need to regulate.
Absolutely.
I think to your point on money moving slowly there, Dave, too, as well. I think the thing, and this ties back to what I think MetaMask has done a great job of, that does need to change and continue to improve, is adding a better front-end user experience as either an institution or a retail investor. And that's really what's helped open up this space. I think the difference in tools and the access that you have as a retail user and as an institutional user are going to look vastly better and different 5 years from now than they do today.
Yeah, and I think that's really the if you think of the adoption cycle within fintech, it's very much has taken that that trajectory. And I think a big part and a focus for DeFi generally, and I think a big thing we're thinking a lot about within ConsenSys and specifically within the MetaMask institutional team is like, how do we abstract those user experiences in the best possible way? And we won't solve that problem today or potentially tomorrow. I think we're very much focused on technical architecture and best execution, but I can't agree more. I think for us to cross the chasm, UX and UI is going to have to be very important. As as non-technical as that might sound, and as heretical as that might sound in the DeFi space, like UX and UI is very, very important.
I agree with that.
Awesome. So we've actually had some excellent questions coming in through the Q&A. So now we're going to move to answer some of those questions. So this is from Benedict Getz. Where and how do you see the old financial world, the Goldman Sachs's, the Morgan Stanleys, compete for an ever more tech-savvy new generation of investors who don't want to be tied to the traditional financial ecosystem?
I can jump in here to start, unless somebody else wants to take it. But essentially, I think what you're seeing with all the large institutions right now is focusing on a few things. One is, it is so much easier to start and grow a new fintech now with the tools you have than it was even 10 years ago. So a lot of them are starting completely separate new branches, like Goldman Sachs's Marcus. There's lots of other examples here of trying to start a neobank and using a fundamentally different tech stack to try and provide a better application experience. So I think that's the first step that you're seeing here in terms of trying to bridge the gap between going to your bank in person down the street and accessing it only via your mobile device. And tools like Plaid are being used as part of that. I think the next wave you're going to see is then offering exposure to crypto as an investing asset class via things like Bitcoin ETFs and the like. And then I think you're going to see the wave of actually trying to adopt DeFi into those applications directly. And I think that evolution is underway, but those are the stages I would think that you're going to see from the institutional side.
Yeah, I agree with that. I have one more view on it. I think every traditional financial firm today should be thinking, how is the cryptocurrency space going to disrupt my current business, right? And if they're not thinking it, they're sort of way behind. But we know, at least the forward thinkers are saying, okay, I see what's happening here. This is going to be disruptive to my current business. What do I need to do, right? So buy, build, or partner, basically, are the three answers. Traditional financial firms are all thinking across their platform, right? Like Keith mentioned, Marcus on the retail side, but Goldman Sachs or all, and every one of their competitors is thinking, okay, how do we build this into our trading revenue? How do we build this into our asset management arm? And is it, what's the best path to do that? So, and I think a lot of the time, what I think you're going to see in terms of evolution is that it's customers don't really care, right? If you get back to what I was saying before, customers want better, faster, cheaper, and the firms want to retain margins. So it could be on the back end where customers won't even know they're trading on blockchain driven rails, and you're going to see stock trading is going to evolve because the large, the exchanges are going to need to move faster. If you look at today's CeFi exchanges and DeFi, right? Our space is moving 24/7. We're doing, live updates to our systems. Whereas if you want to update a traditional exchange, they close on Friday, it takes them 48 hours. Sometimes they reopen on a Monday, right? We're running 24/7, things never stop. These are much more sophisticated, right? So you're going to see this rail switch over time, and customers won't even know the difference in the end. It's sort of like in the back end.
Yeah, I know we're supposed to disagree and argue on these panels, but I think we're in complete agreement. I think, to echo Dave's point, I think that abstraction piece is so incredibly important. And I think we're in a phase where we're basically building the infrastructure at the moment. So we're seeing this, a lot of crypto native custodians are getting very large investment from traditional players. So I think you're seeing that movement as well, that infrastructure being built so that, the Vanguards of the world or the BlackRocks of the world can potentially hold these assets. And then obviously, as I mentioned before, you're also seeing a lot of that infrastructure happening on the protocol side. So you are seeing, DeFi projects being built now specifically for the institutional world that will help them bridge that gap. So, we're talking about best execution as an example, AML, KYC, another one yet again. You're also seeing protocols that are, launching things like institutional lending protocols so that, solving that need specifically for them. And so I think at this stage, we're very much in the investment phase of kind of DeFi generally, but without question, the Vanguards, the BlackRocks, the Fidelity of the world are absolutely thinking about the space. I think the adoption of it is also going to be very much through indices. I think you've seen the success of the Bitwise index launched at the start of the year, which has been seen, incredible success over the last few months. And I think you'll see more and more DeFi indices come into fruition to give these players and actors space, a way to allocate to DeFi essentially. So I think like that is another channel into the space. And then I totally agree with Keith. We'll see the innovation is within the neobanks. That's going to be the bridge where you're going to give consumers in the retail market access to the space. You'll see the Revoluts, using layers like Plaid, to give the retail market that bridge. And that's what you'll see, the best UX, the best UI, and that bridge within retail.
So there are a lot of, and I'm going to kind of build off a question that Dina Ellis Rochkind is asking in our Q&A. DeFi is wonderful because now people across the world can have access to financial products who might not have actually been able to get access to those financial products. We see it actually a lot in our MetaMask user profiles, where a significant amount of users in the past few quarters have actually been coming from countries like Nigeria, like Argentina, etc., who are really using MetaMask as an alternative because they can't necessarily get a bank account within those respective countries. But there's also a really dark underbelly to DeFi that I don't think is discussed enough. Billions of dollars have been lost through exploits, through developers effectively stealing the funds because they have control over, they control the admin keys where all the users' funds are deposited. And I've seen these developers and project managers, et cetera, 3 months later, start a new project that attracts billions of dollars. We have really come as an industry to really believe in this sort of test and prod, test and production, get the code out there. It doesn't matter if it's going to be exploited, et cetera. Get it out there, and oh well, it's the user's fault because they should have been smart enough to read through the smart contracts to figure out where the problems were. That's obviously not very realistic. It also creates a culture where there's very little accountability. So how do we effectively counterbalance the wonders that DeFi is doing with that lack of accountability? And how can DeFi be regulated without killing it off?
Look, I think it's sacrilege to say on a panel like this that we need more regulation around it. And I think people are always concerned that regulations kill things off. But really, regulations enable the bigger swaths of money to come in, right? And that's what's going to happen here as well. Look, I respect the regulatory bodies, right? They are smart, they're forward-thinking. They're, not everything is perfect, right? We're dealing with the law of large numbers, but they are considerate, and they're going to need to come into this space, just as we saw in the CeFi space. Moving towards a more regulated place protects the greater number of investors, right? So there are some give ups for that, but you enable larger and larger pieces of money to move. Look, I think actually I wanted to mention before, like, one of the places that we could see the biggest swath of money move if we get the regulations right is the fixed income markets, right? First of all, everybody's always focused on stock trading and then crypto. They draw parallels to that, but not a lot of people are really thinking about the fixed income markets. First of all, they dwarf the size of traditional stock markets, and they are ripe for this type of technology. They're in the dark ages technologically wise, and I could see them leapfrog to this type of platform very quickly, and we would see, regulations would help that a lot.
I fully agree with Dave there. I think if you want DeFi to be successful in the long run, you have to get deeper adoption, and adoption is going to come from trust, and trust is going to come from regulation. And so I think there's going to have to be some give and take. There will probably always be corners of this world that are the Wild West, and that hopefully those corners can still offer benefits to people that aren't able to access the ecosystem via regulated methods. But I think if you want this to go mainstream and really have the level of impact that I think it can, there will have to be things like AML regulations that get brought into play here.
Yeah, I think it takes me back to one of your opening questions on how do you define DeFi. And I love this Matt Ridley quote that says, "Innovation, the child of freedom and the parent of prosperity." And I think if you look at most industries, and I hate this phrase, that haven't been disrupted, most industries haven't been disrupted except for finance and healthcare. And these two industries haven't been disrupted because they're so heavily regulated. And I think what DeFi is this beautiful ecosystem where we have radical experimentation, radical innovation, and also radical freedom. And with that has the potential to bring along radical prosperity. But I really do believe we only cross this chasm if we have eventually some form of regulation that, adds that layer of trust, essentially. And so I do think it's very, very important for us to, get the next 5 billion people into DeFi. And I think with that regulation, I think it comes back to something that both panelists have mentioned before. We need to be thinking about how do we abstract this layer, right? Like, my friends and family don't really understand how blockchain works. And so I think it's very, very important as they're using better financial services that they don't know how to, need to understand that they have to memorize seed phrases and be an expert in total value locked or over collateralization. And so I think these two things are very, very important, both the regulation and this idea of how do we abstract a lot of this complexity. And through those two things, I think we can cross the chasm.
Absolutely. So I think it's interesting to discuss. I think we're all actually all in accord that thoughtful regulation can bring number one, it can bring greater accountability to the space, make it safer for users to interact with. Number two, that regulation will allow larger pools of capital, a larger portion of the world to now access the ecosystem. And this is particularly interesting thinking about the context of Gary Gensler, who's set to be confirmed as the chairman of the SEC. One of the things that I really push back on when I hear it in crypto is, oh, the regulators don't know what they're doing. And I've watched Gary Gensler's, he taught at MIT Business School, and I've watched some of his classes where he's talking about various crypto projects, where he's talking about the crypto industry. And he has a very, very deep fundamental understanding, better than honestly many people I work with within the industry, not at ConsenSys, of course, but outside of ConsenSys, about what's actually happening and the disintermediations that's going on, etc. When Gary Gensler, when the CFTC, when the other regulatory bodies start to decide to take action, where do you think they're going to really focus on the regulation aspect? Is it going to be the really focusing on the centralized exchanges, turning them into the entry gateway points for the rest of the ecosystem, enforcing the current rules of not allowing these addresses that aren't KYC to interact with those exchanges? Or are they going to go after the more decentralized players, the operators, the development teams, etc., that are currently that could be viewed as running something that's not regulatory compliant? Would love to hear your thoughts there.
Yeah, that's a really insightful question. I'll give a very narrow answer based on my purview of the world. I think the regulation that I mentioned earlier, the AML 5th Directive, is a really big deal. And I think it's going to play a much bigger deal, specifically within DeFi and decentralized exchanges going forward, specifically as more and more institutions step into the space. And so I foresee that that's going to be a focal point within this space. How do funds, institutions, enterprises fundamentally understand who their counterparties are? Or if they don't, as obviously the beautiful feature that is DeFi and DEXs potentially now becoming a bug, if they don't, how can they manage that risk effectively? I don't think I have a good answer for you in terms of what happens next, because I think it's very much dependent on regulatory bodies. But I do know a lot of institutions that are fundamentally thinking about this problem and putting in place processes, infrastructure, in order to have very good answers when they get a knock on the door. So for me, that is essentially what I think is like one of the most important things to be thinking about. Like, how can you ensure that when you allocate capital to the space, when you're stepping into the space, you can manage that risk? And I think that's actually where regulators are going to be cracking down first and foremost.
Yeah, look, I agree. I think there's a fundamental sort of misunderstanding. And I sort of get this question all the time, like, when are the regulators going to shut down the crypto space? I think that's a misconception. That's not their goal at all, right? They actually like digital finance because it's trackable. It's much more open, right? It's way better than the cash markets used to be, right? Like this is a much better end result for them in the end, right? So this is a function of eliminating bad actors. And I think SROs are going to be a very important model for this space, right? Like, we need to show that we are a bunch of mature adults and can regulate ourselves before or it's going to be, or they're going to have to do it for us. And I think we can do that.
Awesome. And yeah, I was just building off of, I just want to make sure she gets credit. That was Dina Ellis Rochkind's question. Keith, Johan, Dave, thank you guys so much for being here. We're at the top of the hour. We want to make sure that we don't go too far over. So really appreciate you being here. It's clear from the people and from the Q&A that this is very much appreciated. Cannot thank you enough for your time.
Thank you very much, everyone.
Have a great.
Thanks for having us. Appreciate it.
Bye.
Bye, everyone.